Mahantesh Sabarad now joins in as well on the show. Mahantesh, blame it on a number of factors. Could it be potentially what we're seeing with respect to those inflation fears, as well as the surging commodity prices and those those COVID cases rising at a very hectic pace? How are you expecting the next few days and weeks to pan out for the equity markets? Because so far it's been a sideways correction, but do you think that, if these external factors were to worsen, that we're in for a fairly dangerous route on the markets?
Good afternoon first. So the markets have been correcting lately after having reached a peak, but then I would say that we are not reaching any dangerous levels in terms of the risk behavior sort of affecting the market. So the risk is not getting too much or too dangerous for stocks to really tumble. Despite this fear about the COVID cases rising, I would tend to believe that the risk in the markets are not pertinently high, and therefore we hope that recovery will follow suit. These stock corrections that we are seeing primarily in the frontline stocks would probably abate after a couple of sessions.
Banking sector, because that looks like it's a bit of a pain point for the markets right now. Would you be picking up some of these private sector banks, NBFCs, insurance companies on dips?
Yes, since banking sector is the dominant portion of the market, there are opportunities galore available, particularly now in the NBFC space as well. But having said that, one has to be a little careful, because what happens is when you have rising bond yields, and the yields are not significantly high, I would say. In such situations, you would be careful about picking only those companies who have a strong capitalization. If you look at from a balance sheet point of view, many of the analysts will typically tell you that you have to look at both the liability side as well as the asset side. The asset side would primarily focus on what kind of NPA levels are there. On the liability side, you would focus on what the capital is, and of course there's some element of the franchise that the particular bank or the NBFC has. So to sum it up, I think now is the time in the market where you will rather focus more on the liability side, and especially within the liability side, you would focus on the capital that most of these banks or NBFCs are maintaining. So when you have a high level of capital adequacy ratio, your growth ahead is in a way secure. Your ability to absorb shocks from any NPAs or structurally higher NPAs coming in is existing. So higher capital adequacy ratio companies or banks or NBFCs are what we would pick up in this market.
Okay. And we are also in conversation with Kunal to get a sense of what is happening in the market. And meanwhile, if I look at the Bank Nifty, it's almost like a vertical fall. Between Friday and today, it's almost 1,000 point, maybe more than 1,000 point cut. Very few stocks are holding on in the F&O space. Banks are on the receiving end, and NBFCs typically, when there's risk off, NBFCs and financial stocks are the first ones to crack. Mahantesh, now I'm not surprised with the selling in banks, but I'm also surprised with the strength in metals. If there is a risk of trade in the world, metals are the first one to crack, and then it is banks. Banks have fallen on expected lines, but metals are holding on. All metal stocks from SAIL to Vedanta, from Tata Steel to even Nalco, they're trading with a positive bias.
So I think the metal rally has got to do with the belief that the manufacturing activity has resumed at a very rapid pace, particularly in China. And driving that is this belief that the US stimulus package provides that vital consumption boost, which will drive up the demand for metals. Eventually, metal demands will come from a higher level of consumption in US, better economic activity across the globe, new investment activities that get driven up. You also can visualize a situation where when crude oil prices go up, the ability to invest in your projects, in oil producing projects or related projects goes up. So all this is driving up essentially metal prices. Plus, we also have within metal a peculiar phenomena linked to the entire surge coming in from EV side, electric vehicle side. It is getting generally believed that as we move into the EV space more and more, the consumption of certain metal elements will go up, and that is driving up the prices of those elements, generally leading to this whole metal rally that we are seeing currently in the market. So the disconnect that you are probably seeing has got to do with this phenomenon. The stimulus package led consumption boost, leading to high level of marketing, manufacturing activity pickup, plus localized or certain metals getting that undue attention because of the EV surge. Why I'm saying undue is because many a times we find in markets prices rally ahead of the actual event, and that is probably is happening right now. So it is due later but undue now. That's what I want to say.
So today as well, a Coforge is up 3.5% and Mindtree is up roughly about 2.5% or so. And even within the big boys, the TechM, HCL Technologies are far resilient as opposed to the other nifty players. Mahantesh, where is it that you stand on this entire IT trade? I mean, growth not getting challenged, but would you say on dips, these are good opportunities to buy in still? Any of the mid-cap IT names that you like?
So we have an outstanding call on Coforge. So to begin with, the pick that you're talking about, so that's the one. We do like certain mid-cap IT names, but generally speaking, most often than not, we would rather recommend the large caps within the IT space than the mid caps. The only good thing going better for IT companies is that in a COVID kind of environment, their business is working nearly as usual. They may have challenges in delivering services to a certain set of clients, but the orders that are not cancelled, or orders are not getting postponed. So that tells you that the revenue momentum that they have garnered so far and are likely to garner ahead will continue to remain at an even pace. In fact, it can accelerate further if the recovery takes a solid form. That is what we are expecting, right? If you take our country, we are talking of a sharp double-digit growth in GDP next year. Something similar will be the case. In terms of magnitude, could be different, but something similar will be the case with other countries. So for IT companies who are essentially global facing, they have a possibly likelihood of accelerated earnings growth as we go ahead. So yes, IT is something that we should continue to buy on dips.
Right. Kunal, do you as well sense that, given the resilience of IT each time that the market falls, IT is still in a good stead? And would you recommend a fresh buy on any of the mid-cap IT names?
So, Aisha, yes, I think IT stocks are, and the rally for the IT stocks are yet to continue on the upside. These stocks have gone through a pause. I think largely you can call this, the last 3 months of price action as more of a time correction rather than more of a price correction into the IT names. Look at the way the mid-cap ITs have managed to come back again. I think Mindtree has hit back a fresh high for itself, if I'm not wrong. And I think similar could be the case with the other, mid-cap ITs sooner or later. So I think in that aspect, it's that the IT uptrend is continuing after a bit of a pause. And I think if that's the case, then I believe that the large cap ones which have shown signs of potential earlier could be also one of the few of the names which can pick up price action. So I think Wipro was one of the stocks which I've been bullish on earlier. From the sub 300 levels, I think even at current levels of 420, 430, Wipro still looks fairly attractive to me on the long-term charts, and I believe that the stock holds strong prospects over the longer term. From the other names, mid-cap IT stocks, I think Tata Elxsi and Mindtree are the two names which I believe could be something to look at. So Tata Elxsi, especially after that 5x kind of a run with the stock has seen, I think any kind of a significant correction, a 20% correction or a 20 to 25% correction from its recent swing highs should be a good entry point for stock like Tata Elxsi. And Mindtree, I think the stock has been into a very strong momentum even on the short-term chart. So it depends on the kind of time horizon for a trader, but I think at current levels as well, purely playing as a momentum strategy, I think Mindtree could be a good opportunity to trade with.
Mantesh, if I would have constructed a scenario which is that at the beginning of the year, bond yields will go to 1.6 in US or even above that, the automatic answer would have been that that would lead to a sell-off in the market. But minor a blip here and there, some bad days, lot of volatility, global markets are holding on. So do you think we are in for a period of choppiness before the big sell-off, or the adjustment or the global adjustment in respect to the bond yield is over and FI flows are unlikely to reverse?
So firstly, let's not look at the bond yields in US alone. You have to actually look at the real interest rates in US, and one of the proxy to that is the inflation protected securities that they have on a similar time scale. If you look at that, the US real interest rates are actually negative, and despite the spike in the bond yields, the spike in the real interest rates is not happening. We are still in the negative territory. So the bond sell-off should really happen, and therefore the equity sell-off should really happen only when you are nearing above the zero zone, that means you're in the positive territory. So that's the correct way to look at it. That's why what we are seeing is that whenever the US bond yields spike, there is a accompanying volatility in the market, but overall there is, after a few days, the effect wears off, and we don't see that big sell-off coming just as yet. There's another phenomenon that is happening, is balancing the rise in the US bond yields is the strong recovery that you're seeing in US economic activity, prompted by the stimulus package. Thus far, for the past few months, there was always this debate about whether this stimulus package will pass the houses, whether it will come out in a different shape. Right now, it has come out in the shape that it was originally envisaged, so it's come out intact. And it's a fairly large stimulus package. So what happens is that between the rising bond yields and the higher economic output that you will see, asset price inflation will remain curtailed, or on the other side there won't be a big asset price correction. So that's the broader view that we would tend to hold right now. But disturbing this view would be, or the risk to this view would be, what happens locally within our country. Or that means our economic recovery fails to take off, or it does take off but at a lower or a slower pace. Then we might have a correction in our kind of markets. We are in that overvalued zone. Let's not say there's no two ways about it. Let's not deny the fact that we are in an overvalued zone. But just as we are in the overvalued zone, globally, most equity markets are also in an overvalued zone. How long will this overvaluation exist? According to me, this overvaluation will exist so long as there is supportive monetary policy, supportive fiscal policy globally. And as of now, I don't see any reasons for those policies to be withdrawn, either in a gradual manner or in a strong move. So long as we have those policies which are fair or liberal to the markets, I don't think we are going to see asset prices correct by too much.